Hey folks, Rachana Ranade here. Today we are unpacking one of the most talked about pieces of market research of 2026. A viral report called the 2028 Global Intelligence Crisis from Citrini Research. Well, the report starts with the date 30th June 2028 and it reports what has happened in the last 2 years. But you might be like, Asa kasa kai? Now understand. It's as good as the author or the person who has done the research and who is writing this article has sat in a time machine. He has flown to 2028 and now he's looking back what has happened in the last 2 years. So it is his imagination, but not just random imagination. It is his hypothesis of what has happened in the last 2 years based on which this article has been published. Now, this isn't just another AI article. This is one that has shaken global markets and even triggered sharp sell offs in tech and software stocks. So, if you have seen headlines about AI causing unemployment, breaking economies, or even something like ghost GDP, stick with me till the end because we are breaking it all down in simple and practical language. That's a perfect downward trend line breakout. But here's the crazy part. I didn't draw that trend line manually. I coded it using AI, converted it into a Pine script, and ran it directly on TradingView. Now imagine your charts identifying trend line and breakouts automatically. So if you want to level up your technical analysis using AI, join my live webinar on 8th of March at 11 a.m. Seats are filling fast. Enroll now. Now, let's understand the core thesis of this report. Basically, this research report is trying to understand what disruptions can AI create. And the researcher, as I mentioned, has gone into 2028 already and is looking back that what AI disruptions have happened from the year 2026 to 2028. If this is clear, understand what is his thought process. The researchers feel that machines and AI get so good, get so fast that human intelligence becomes less valuable in many jobs, even in white collar jobs. See, typically, how are we brought about, or what is our typical upbringing? Upbringing says that if you are intelligent, if you work hard, you will get good jobs and you will earn more. But then the thesis that is being challenged here is that, okay, you are intelligent, agreed, but artificial intelligence is more intelligent than human intelligence and that can perform way better. Based on this, the entire hypothesis has been built, right? Which is true to some extent. Now, companies will replace humans with AI agents to cut the labor costs. Has this already started to happen? Yes, to some extent, but this report says that this can go to the next level. Now, what if humans are replaced with AI agents? This boosts corporate profits and productivity, but many people lose their jobs or take lower paying jobs. So you can imagine that if some software engineer loses the job, that person is not going to just sit at home. That person will take some job, maybe even if it is a lower paying job. Now, what will happen with this? Workers or employees will earn less. If they earn less, they'll spend less, and that reduces consumer demand. So the economy shows strong headline numbers because some companies, maybe some AI companies, are doing good. So overall headline numbers will be good, like GDP growth, that will be good. But the problem is that the real economy will weaken. And this is what the report calls as ghost GDP, economic output on paper that hardly circulates back into real consumer spending. So, what is the whole loop? In simple words, some companies will earn more because they are replacing humans with agentic AIs. With this, what will happen is unemployment will increase. If unemployment increases, people are going to earn less. If they earn less, they will spend less. And if spending drops, overall circulation of money is also going to drop down drastically. I hope the central story is absolutely clear. In the next section, we'll talk about the sectoral impact. Now let's think beyond basics because everyone understands that be it software or be it IT, these things can easily get disrupted with AI coming more into picture. Instead of human beings writing multiple liner codes, now everyone knows that with the help of Claude or Chat GPT or whatever, you can easily write codes. So disruption in software and SaaS is very much understandable. But we'll just go one step ahead and try to see whether there could be disruptions in multiple other sectors as well. So let's take an example of quick commerce. Now, you might be like, seriously, can quick commerce get disrupted in the next 1 or 2 years to a massive extent? Possibility is yes. Why? Again, this report is in 2028. They are looking back and they are seeing now who places orders. Let's say we are talking about placing an order for dosa or any other food item on you are not going to decide, I'm not going to decide, AI agent will decide which will be the app or which will be the platform through which the order will be placed. Because agentic AIs, you just need to tell them order a dosa. Now agentic AI will search how much is the cost of dosa of that specific restaurant, which is being shown on Swiggy, that is being shown on Zomato or any other food delivery app. It will compare the prices and it will ensure that the order is placed directly on that food portal where the price point is the lowest. Right now, what happens is that, let's say I'm used to using Zomato, I'll automatically go and place an order on Zomato, but that might not happen when agentic AI start placing your food orders. So could it effectively disrupt even the food delivery space as well? Possibilities, yes. There could be one more example of how something like Netflix or Amazon Prime or such other apps which work on renewals, how can those get impacted? Now I'll tell you, I do have one or two such subscriptions which I don't consume content on these subscriptions for even more than 8 to 10 days in a whole year, but it gets auto debited and I'm like, okay, chalo, theek hai, it's debited, it's okay. But now what will happen, once agentic AIs also can renew subscriptions on their own, I can code them and I can tell the agentic AI that just check if I've not used that specific app for more than, let's say, 1 month in a year, then discontinue it. So in such cases, it will lead to a death of passive renewals, right? Let's also understand one or two more examples. Let's say today I'm planning a trip to some destination. Right now I would go to a travel agent, but these days I'm sure you are already doing itineraries with the help of ChatGPT or Gemini or Claude or any other AI tool, right? But now again, with agentic AI coming into play, what will it do? It will go on to different websites, be it Make My Trip or Yatra or whatever. It will search which is the cheapest option available and will book your tickets, will book your hotel based on the cheapest available thing. Now what will happen because of this? Three examples I gave, be it food delivery apps, be it subscription based apps, be it travel related programs, what is happening is lowest is being selected automatically by the agentic AI. Now your pricing power somehow vanishes. Right now, what these companies do, for example Zomato, they'll insist, they'll try and ensure that you download their app. Why? Because if the app is on your phone, automatically you will use that app and place the order. But agentic AIs are not going to use apps, they'll have their own way of placing orders, and because of which pricing power of so many companies can go for a toss. In fact, it also goes one step ahead and says financial services could also get hit. Why? Right now, how do we use the pay option? We'll just see one or two coupons if they are available or not, and based on that we'll just take a call. But agentic AI, if it is allowed to do all these payments also, it will say that okay, maybe blockchain is the cheapest way. It's the, I mean, it's the way wherein the costs are extremely less and it can place order using blockchain as well. Of course, in India right now it is not allowed, but we are talking about a report in 2028. So if this gets allowed, there is a possibility that credit card companies may face a challenge, some other payment apps may face a challenge. So all in all, it is saying it's not disruptive only to the extent of IT. There could be multiple other areas where this disruption can be seen. I think a special mention needs to be given for housing finance or entire housing as a sector if we are talking about the 2028 scenario. Now, how could 2028 be different from 2008? Oh, both ending with eights. Okay. Now, what had happened back in 2008 was that whenever loans were given to people who did not actually have the repayment capacity. So these were essentially bad loans which were given and they had a high risk of default. But what happens in 2028? Now, when the loans were given, maybe in 24, 25, or maybe 1 or 2 years earlier also, loans were given to people who were like white collared, people who were doing white collar jobs. They were earning good salaries. There was no problem with their repayment capacity. And in fact, the entire housing finance is based on the assumption that if a person is earning X rupees of salary, that person will continue earning salary over the next 20 years, over the next 30 years. In fact, will keep on increasing his salary. Now, can I say this assumption itself gets questioned? Yes. With AI's white collar jobs come under the firing range of AI, and white collar jobs can see the biggest problem. Now, with this, what can happen? A person who had the repayment capacity starts to default. And this can have a cascading effect. How? More and more people defaulting is equal to same thing, more and more houses which have to be now sold off by the banks or by the financial institutions. That will lead to a housing crisis. The problem for financial institutions is that they had given a loan, they are not getting repaid. So whatever money they had given, they had not printed notes and given it. It means that they had also borrowed money from someone. Now that from someone could be possibly, let's say, a housing finance company might have raised money through debentures. Now there could be a default in those debentures. One more possibility could be that, let's say, some insurance company had invested their something like a guaranteed return money or money back policy related money premiums. Basically, insurance company had invested the premiums in the housing finance company. Now if the housing finance company is not able to recover the loan, can I say the cascading effect can also go to insurance companies. So you can imagine, loans not being repaid is having a cascading impact not only on the home finance companies, entire real estate sector could get hit, and also companies like insurance companies, the investors who had maybe invested in the debentures. So I hope you are understanding that this is not an effect or impact only on IT, it is pretty huge. Well, I just told you about how 2028 is different from 2008. But if you want to learn more about 2008 in detail, just comment 2008. I had done a separate 1 hour classroom session, which was a part of my basics of stock market, and I recorded that back in 2020. If I get at least 500 comments saying 2008, I will be more than happy to release that 1 hour lecture on 2008 crisis on our YouTube channel, right? With that, let's understand the market impact that is projected by this report. As per this report, the unemployment rate hits 10.2% by mid 2028. This is a crazy number. Just to give you some perspective, 10 to 14% was the unemployment rate back in 2008 and also during COVID scenario. So is this 10.2% extremely high? Answer is yes. If I'm talking about the market, they say that S&P 500 has dropped around 38% from its 2026 highs. So they are not only expecting a downward pressure in the employment scenario, they are also saying downward pressure, massive pressure in the stock market as well. According to them, tech and software stocks, especially enterprise software, are the ones which have hit hardest. But why? Because of all these businesses rely on human labor embedded in services or ongoing revenue from human centric products. So the main point that I mentioned, right, that majorly why enterprise software companies will get hit, because these businesses are currently relying on human intelligence, and if that itself is getting replaced, it will end up in a negative feedback loop, which I just mentioned, but I'll repeat it again. What will happen is AI will cut jobs. If jobs are less, consumer spending will be less. If consumer spending is less, it will lead to weaker demand. And if there is weaker demand, companies' top line will be questioned. So they would want to again ensure that their expenses are less. For that, they will again cut jobs and they will automate more. And this will keep on spiraling. So I hope you have understood that the market impact is also going to be pretty high. Now, you as investors, what should you do? Here's a practical takeaway. Number one, don't panic. This report is a worst case scenario study. It's a dramatic one. It is not a guaranteed prediction. Okay. So, very important, you also have to balance your perspective. AI is a real productivity booster, agreed. But narratives can drive markets in the short term, especially when investors are crowded into one theme. Very important, what you should do is you should monitor fundamentals. Check employment data, check corporate profits, check revenue growth, check the sectoral rotation, and don't just rely on headlines. Do a little bit deeper study. Extremely important point again is diversify your portfolio. Diversify it across equity, debt, and commodities. Just to close off today's session, I would want to quote one line which I had read it somewhere, that hearing that the world is going to be hell is more interesting than forecasting that things will gradually get better over time. In simple words, pessimistic studies go more viral than mildly optimistic studies. So I believe that this is an extreme pessimist scenario. Should we take this into consideration? Yes. But should we panic sell everything? I don't think so. But what is your take? Let me know in the comment section below. If you did find a lot of value in today's video, please don't forget to smash the like button. Please don't forget to share this video with your friends. I'll see you in the next one. Till then, take care. Jai Hind and bye bye. You might have come across such advertisements on various social media platforms. Please note, all of these are fraudsters promising unbelievable returns through stock tips. I don't provide any calls or advisory services. I provide only educational content through my social media handles and through my website rachanaranade.com and rachanaranade.in.